What's up, guys? Today we're going to talk about Unit 4, the financial sector, topic 4.4, which is banking and the expansion of the money supply. All right. We talked about the multiplier effect previously. And so there's another type of multiplier effect when we're talking about banking, and it's called fractional reserve banking, right? And we'll look at that here in a second. But let me first explain what fractional reserve banking is. So when you take your money and you go and you deposit it into the bank has to hold a little bit of that money, right? It can't lend all of that money out. It has to hold a portion, and that portion is set by the Federal Reserve, and that's called the reserve ratio, right? And so every bank has to abide by that. Now, how the multiplier works, right, is if you go and you deposit $100 into the bank, well, the bank has to hold again a percentage, the reserve ratio, and we'll say it's 10% in the United States. And so they hold 10%, that goes into the vault, right? Nobody can touch that. And then the $90, well, that's excess, right? So they need to lend it out or they need to figure out what they're going to do with that. So a lot of times it'll just be part of, it'll go into the pool for a loan, right? And then so someone comes in, they take out a loan, right, from that bank. They buy a car, they buy something with that. And then so that money from the car seller is going to go to the bank, right? And then they're going to put a portion of that into the reserve ratio, right? And then it's going to go down and down and down until every dollar is spent, right? And you can see here, right, or hopefully you're following along, that actually creates money, right? If I were to take $100, deposit that in the bank, that creates $90 that someone's going to go out and they're going to, withdraw that $90. They're going to put it in their bank, which they'll put $9 in their bank and spend $81, and then so on again until every dollar is spent. And so that leads us to the multiplier effect. And so how do we come up with the multiplier effect? The multiplier effect is just going to be 1 over the reserve ratio. So in this case, the reserve ratio is 1 over 0.1, right? And so the multiplying effect would be 10, right? So the $100 that I put in times 10, that creates $1,000, right? Now, next we're going to go over bank balance sheets. And with bank balance sheets, I'm going to go over a few definitions, and then we'll get started on them. So demand deposits, that's money deposited in a commercial bank in a checking account, right? The required reserve, or the reserve ratio, right, is the amount the bank can, the percentage the bank must hold by law, right, in the vault. And then excess reserves is anything that the bank can lend out, right? So, your deposit is going to be split up into reserve requirement and then excess reserves. And then the balance sheet is the record that the bank has at the end of the day, showing its assets and its liabilities and its net worth. Now, the balance sheet is pretty simple, right? It's balanced so that both sides' assets and liabilities need to equal each other. Now, every bank has a balance sheet, and they check, periodically throughout the day to make sure that they're balanced out and that everything's working out. And if they're not balanced, right, then they need to call another bank for an emergency loan and take out loans from a bank or even the Federal Reserve. But we'll get into that later. Anyway, if we look at a balance sheet, and we want to let's look at slide number 9. It shows us liabilities and assets. So if we were to look at the loans, let me go ahead and write this out, and you guys can do the same too. And so you have assets, you have your liabilities, and you have your, I'm just going to abbreviate a few of these things. 5,000. Owner equity. Assets and loans. Okay. So, you can see this here, right? We see that you have your assets, which are your loans, your reserves, your T-bonds, and if you were to add all these up on this side, it would equal 10,000. And then on this side, you have your liabilities, which you have your demand deposits, which is 5,000, your owner equity, which is 5,000, and that's going to equal 10,000. Now, so let's look at a few things here, right? One, if you were to go in and you had $5,000, and that's all, that's you're going to deposit that into the bank. Well, this is all of the bank, right? Not just one person, but we're going to use you as an example. So you go in, you put in $5,000. They have to, by law, put in it into the reserve, right? The reserve requirement. So here we can see that the reserve requirement, the reserve ratio here is 0.1, right? This is 0.1 of 5,000 or 10% of 5,000. So the 5,000 stays in the reserves. We can't touch this or do anything with this. Now, some assets they have is that they have some loans that are out, and they also have purchased some T-bonds, right? And so, if some of the loans come back in, they can move that into excess reserves. So there's quite a bit of movement that can happen into this example here. Now, let's say that someone comes in and they're going to deposit. Let me change some of these numbers real quick, right? So demand deposits, we got 20,000. And this we got 5,000. T-bonds, 5,000. Reserves. All right. So here we go. So let's look at this real quick. Here we've got again, our liabilities, which are demand deposits, are 20,000, right? We've got our owner equity, which is 5,000. We've got excess reserves, which is 3,000. Our regular reserves, which is 2,000. Our T-bonds, 5,000, and loans are 15,000. Both sides equal 25,000, right? So we're balanced, right? Now, let's say someone comes in and they're going to deposit $1,000 into the bank, right? Well, what do we need to do? If they're going to come in, the demand deposits is then going to change from 20,000 to 21,000, right? Well, if it changes to 21,000, right, then we're unbalanced, right? We have 26,000 on this side and 25,000 on this side. So we need to add the 1,000 to this side. Now, 10% of that needs to go to the reserves, right? Because originally this 2,000 was 10% of the 20,000, right? So this is going to change to 2,100, right? Well, now we still have $900 that needs to be moved in here somewhere. So where are we going to put that $900? We're going to put it right here in the excess reserves, right? So that'll be 3,900. All right. And now if we were to add these back up, right, this is going to equal 26,000. This equals 26,000. So our balance sheet is then balanced, right? And so then we want to know, okay, how do we determine let's say, what's the multiplier effect of this? Well, it's going to be 1 over 0.1, right? Because again, it's 10%. So 1 over 1.1 is 10. So you take that 10, you multiply it by the deposit, and that would generate the multiplying effect, okay? Or that would generate the how much that's going to multiply into the economy, okay? And so that's an example of balance sheets. Hope you guys got that, and see ya.